Welcome back to the Monday Morning Podcast. I just wanted to talk today about the stock market. It's been a rough week. I don't know when you guys are watching this. Today is actually Saturday, but it's been a tough week and it's been hard to digest the drop in the market. We really haven't had a significant weekly loss like this since almost the beginning of the pandemic. I know there were dips since March of 2020, but this felt especially brutal. And I want to get into why this happened. And I honestly believe that this has to do with the 10-year treasuries. And I know people have said this. I saw it on CNN or CNBC Money, and I understand that the general population, though, is probably not aware of the correlation of U.S. treasuries. And it's very simple, and I'd like to explain. So what I have here is the Wall Street Journal website. Just the history. It's just they publish the 10-year treasury rates, and it's what I use to analyze this kind of stuff. And so both the 30-year, this is let's go over the last 5 days. So over the last 5 days, you can see that the 30-year, the 10-year, 7-year, 5-year, and 3-year notes, 2-year notes, 1-year note, everything, the yields on these treasury notes were rising. And why is that important? Well, it's important because as the yield on these treasury bills rise, stocks become less attractive. And the reason that is because treasury notes are essentially risk-free investments. When you buy a treasury note, you are buying an obligation from the government, and you're investing in that. The yield is how much money you're going to return, right? You'll get in return at the end of the time period. So if you buy a 10-year treasury bond at 1.12%, the yield, or 1.41%, the yield, that's what you can expect to make back in 10 years. Obviously, it's a little bit more complex than that, but I want to keep it simple. Now, when the market is flooded with treasury notes, when anything is flooded, when there is so much supply, the value goes down, right? Not in this case. And the reason is because no one is buying these treasuries. Going forward, I think it's going to be a little bit different. I think as this $1.9 trillion stimulus bill is passed, it was just passed by the House last night or early this morning, however you want to look at it, and it's going to continue to the Senate. I think next week, by March 15th, is when they expect to have the bill passed. That's going to really affect the market. Hopefully, and I think this is the key to this. So this is why I personally am buying this dip. So I am buying back into the market pretty significantly. And the reason I'm doing this is because I believe that the Fed, Janet Yellen's Fed, is going to buy the treasury notes that are issued from the $1.9 trillion stimulus package. I can go into this in more depth on why the $1.9 trillion stimulus package is important to treasuries. But the reason is pretty simple, and it's just when the U.S. government wants to raise money, when they want to issue the American Rescue Act for $1.9 trillion to help American citizens, how do they get that money? Well, they get that money via issuing treasuries, and they sell those to the public. They sell those to foreign investors, anyone who wants to buy them, and that is their main source of capital funding. And when the yields on these rise, the stock market drops. When the yields on these drop, the stock market rises. So it's kind of a double-edged sword, but it's important to understand the mechanics and why the market is doing what it's doing. So if you enjoyed this, please leave a comment, like, subscribe, and I'll be back for more. Thank you.